Hello and welcome to IDFC First Bank presents Leaders of Tomorrow Season 11. I'm Sunanda Jaiseelan. On the show tonight, we're bringing you all things personal finance, how to manage the wealth that you're making. That's in conversation first up with Fireside Ventures. Also on the show tonight is LotusDew. Our first conversation tonight is with Fireside Ventures. They spoke with my colleague Ritvika Gupta to speak, amongst other things, about some of the common mistakes that they see entrepreneurs making, what are the biggest challenges for entrepreneurs when it comes to fundraising, and just so much more. Listen in.
Well, I'm now joined by the co-founder of Fireside Ventures, Kannan Sitaram, to understand their meticulous evaluation process for potential investments and much more. Kannan, thank you so much for joining us today on Leaders of Tomorrow.
My pleasure, Ritvika.
So, I want to begin this interview by asking you, what are the criteria do you typically consider when evaluating a company for potential investment? How do you assess a market potential and scalability? What can you tell us?
So, Ritvika, as you know, Fireside invests only in consumer companies. That's a focus that we have always maintained is the only thing that we will do. So, within consumer, then we look to see whether a business that we are looking at is actually addressing a very large problem. Second, we want to understand whether they are approaching it in a very, very different manner. Is it a differentiated proposition that they are bringing to the consumer? The third piece is really this approach to solving the consumer's problem. Can it be done in a capital efficient manner, or is it going to consume a lot of capital? Fourth is the whole area of unit economics. We believe that consumer companies should have a path to profitability over a 4-5 year period. And therefore, we want to be sure that every business that we invest in, we are sure of that path to profitability. And last and the most important part is really how we think about the founders, their ability to scale the business, their ability to really execute, every step of the way in the best possible manner.
Kannan, can you give us an idea of the kind of funding that you have raised to back the brands in your portfolio, and also give us an idea in terms of the number of companies that are there in your portfolio currently?
So we started raising money in 2017, and that was the first fund. And in 2017, we raised 340 crores. And we did 18 deals out of that. Then we raised a Fund 2 in 2019 when we raised 860 crores. We just closed a Fund 3 because we had done 14 deals out of Fund 2 and we wanted to reserve money for follow-ons. Fund 3 closed in November of 2022 where we raised 1,830 crores. We are in the process of deploying that, Ritvika. It's been, 6 months since we did the close of the fund, and we have done 3 deals already. We have another 4 deals where we have signed a term sheet and is the process of closing, and we are evaluating a couple more deals actually where we'll be issuing term sheets pretty soon.
If you can also give us a sense of how the funding winter is going to impact the business landscape, and also, how has it been the last quarter for Indian startups? What can you tell us?
If I look at the data, there has been a drop in the volume of funding, the amount of funding in the year 22 as compared to 21. But actually, the amount of money invested in India in 22 is way higher than what was invested in 2020, 2019, 2018. So yes, it's come off its peak, but it's still well above what it used to be. So that's one data point on really where trends are. The other piece is while the amount of dollars invested has come down compared to 21, the number of deals has not come down. The number of deals has actually increased marginally. So when I looked at the next level of data on this, what I see is that early stage investments have continued to increase. What has dropped is actually later stage investments. And that's because public markets have been in a bit of a churn, and the later stage investors are closer to public markets in terms of the stage of investment, and therefore some of them are held back on investing. So I would say this whole area of the funding winter is perhaps it's not really a winter, but there is sort of a season change, if you may call it that.
Kannan, I also want to understand, especially for our viewers, how do you provide value beyond just capital to the companies that you're investing in? In other words, what other resources or expertise do you bring to the table?
This is a very, very important question that you have raised, Ritvika. We have always believed at Fireside that it's not enough to just put money into a company. We need to work very closely with the company to help the company solve different kinds of issues and get them ready for future funding. We work very closely with some of the partners in the ecosystem who play a very important role in growing revenues for our companies. I'm talking about people like Google and Meta and Amazon and Flipkart and Big Basket. All of these are very, very important partners for our companies. We have worked a lot on the next stage funding for our companies. In fact, about a month back, we held an event in Mumbai where we had many of our companies which were going to raise money over the next 6 months to a year. And then we created an interaction for them with potentially what could be the next stage investor. The third area we worked with is really the whole area of governance, because we believe that good governance should start early. So pretty much all our companies are audited by one of the big four firms. And that is again very important, because once you have an EY or a KPMG signing off your financials, that provides a lot of comfort to the next stage investor to come in and invest in a company like that. So there is a lot of things that we do to actually work closely with companies and help them continue to grow from stage to stage.
If you can also highlight the most common pitfalls or red flags that you observe in early stage startups, what can you tell us about that?
The first task of a founder is to discover whether the products he or she has got in the market has customer love or not, what we call product market fit. And therefore it means that checking out the reviews on an Amazon or a Flipkart to understand what consumers are saying about it, and then to do something about it. Now, instead, some people throw money at the problem. They kind of ignore the feedback coming from consumers, and they put more money to acquire more customers. Now, largely the consumer business and its profitability is built around repeat purchases.
Okay.
Therefore, we always keep a very strong eye on to understand how LTVs are moving, how repeat rates are moving, how customer love is shaping up. So that's, I think, a very, very important part of an important pitfall, if you like, that has to be avoided. The second thing is to really think about how the business is moving along. Initially, founders put in a lot of products into the market, and that's the right thing to do, because they've got innovative products. Some products are going to win customer love, and some products will not. And I think that's very important to transition from a product focus to a category focus at some time in the journey.
Finally, tell us, what are the key factors that you believe differentiate a successful startup from those that fail?
The most important one is the founder. And the reason why I say this is there are a lot of very good founders out there. We diligence the founders very carefully before we invest. Now, founders are very good at showing a lot of hustle, getting a lot of things done, solving a lot of teething problems, getting together the first set of team members to scale the business, etc. Founders who become CEOs build a scalable organization. They hire people who are seriously talented. They knit them together into a team. They create processes which enable problems to be solved at lower and lower levels in the organization. And their time frame at which they operate changes dramatically. When you're a founder at an early stage company, your time frame is this month and next month. You're thinking about this month's business, next month's business, maybe one more month out. The founder who's become a CEO is thinking 6 months ahead, thinking 12 months ahead, and making sure that the business of today is being run by the next level team or the team below that. So I just think that this whole transition that I see successful founders becoming successful CEOs, I think that's a very, very, very important transition point that determines the success of companies.
Well, that was a very insightful conversation. Thank you for joining us today, Kannan. It was lovely chatting with you.
Thank you so much, Ritvika.
I'll take a quick break. On the other side, we'll continue this conversation around how to manage your money. That's with LotusDew. Back in a moment. Just stay tuned. Welcome back. You're with us here on IDFC First Bank Presents Leaders of Tomorrow Season 11. Our second personal finance conversation tonight is with LotusDew. Abhishek Banerjee of the company joining us live on the show to talk about wealth management and what are some of the good principles, opportunities, challenges and all of that. Abhishek, thanks for your time here on the show.
Hi.
So LotusDew is an interesting name, especially for something which is in the wealth management space. Just really curious to understand where the idea for that has come about and what the connotation really is when it comes to one's wealth.
Lotus is a flower and it grows in ground. Typically, it's assumed that it grows in a place where the ground is, kind of muddy and a little bit dirty. And the embodiment of lotus as a flower is some of the purest things that this earth can produce as a flower. And similarly, the dew is some sort of evocation of the purest form of heaven, that is a droplet of water that comes from heaven. And LotusDew is the point, in my mind at least, where these two things meet. So it is our kind of way to communicate that we are trying to produce very pure play products and advisors for our customers in the advisory space. And what we want to do is give them very pure products that are different and diversifying from whatever they're already holding. So that's really the way this name came about.
Sure.
What we try to do is, bring technology as a way to identify and screen data and collect data upstream through the different public sources that we have identified through our experience, and apply, generic data recognition and data analysis tools to kind of make our own internal database, which gives us the edge, which from where we base our analysis. So that's really the encompassing view that we're trying to do something different and pure play. And the word LotusDew is an embodiment of where the efforts of being grounded meet the purity of the efforts of sky high ambition.
I want to talk about spending, and spending decisions are an inevitable part really of one's financial life and financial journey. How does having though a solid foundation and a solid grounding perhaps help one make better decisions, whether it is wealth management, whether it's saving, whether it's even spending? How does that really help?
See, knowledge always enables you to ask the right questions, right? Ultimately, when you're managing money for yourself, using your own skills, or if you're using the knowledge of somebody else, then typically in that case, the person who is helping you is helping you as a service provider, like an investment advisor or a mutual fund manager or a PMS provider. Having knowledge enables you to ask the right questions so that you are on top of the game, and that level of knowledge is essential when thinking about wealth management. About spending habits, it is a human thing, right? We earn to spend eventually, for mostly for material things, and now more so for experiences. So when you're spending, obviously, the basic budgeting, you have to take care of that, which means that you cannot spend more than you earn, because then you're constantly getting into debt situations which needs to be resolved. You have to make sure that you are disciplined in terms of first saving for your goals that you've identified and then spending. So spending should not be an afterthought.
In today's rapidly changing space, and we're talking about things like AI, machine learning, etc., how's that helping when it comes to perhaps making better decisions as far as investments, as far as wealth management are concerned?
AI, or artificial intelligence, is a tool, and any form of tool allows you to do something more efficiently. So I think AI is an excellent choice for risk management, where you're tracking multiple sources of data. You're trying to flag what is non-linear, what has not happened, where things, new forms of correlations or data discrepancies are cropping up, and you're able to identify that very quickly with artificial intelligence. The realm of artificial intelligence in investment management is still, I think, some ways off, because it's a discretionary process where you're hypothesizing future value of assets by looking at past data.
What is the role that AI plays when it comes to really detecting potential market risks? Are we at that stage where AI can call out what possible challenges it sees and therefore prevent you and help you from not making that mistake, Abhishek?
If you actually apply basic momentum principles on asset classes, where you're looking at the past performers and the past losers, and kind of putting out the view that past performers will continue to perform well and past losers will continue to lose. That's your traditional momentum investing. There, what we have seen is that because of technical reasons, the prices deviate away from fundamentals. And when you correct these prices towards fundamentals using artificial intelligence in the realm of unsupervised deep learning, you're able to make better momentum strategies that do not have the biases of prices that are way off fundamentals. Risk management basically means looking at a large source of data, typically big data for most cases, and then identifying within that data very quickly what looks off, right? Basic risk management is that normally things are normal, but something goes wrong and can be identified that sooner than others and take corrective actions. By looking at such data through the lenses of AI, I think it's possible to quickly identify the sources of risk and take corrective actions.
Post the SVB collapse, I really want to understand from you what the current wealth management market, especially in India, is looking like, and whether any fears of recession continuing to really rule mind to some extent.
So first, let's understand what happened with SVB, right? Very briefly, what really happened was that they had government bonds on their balance sheet that they used for capital adequacy. And as the interest rates of the government bonds kept rising, the value of their holdings kept falling beyond a point where their customers said that, we don't think you're solvent anymore, so please give us your money back. And they were not able to give the money back in short notice. And that's typically called a bank run, where your liabilities mismatch with the cash flows of your asset. In US, the inflation is very high. The Fed target is 2%. We are running at 5%, which is 2.5 times the target. In India, the inflation target is 4%, and we are running at 5%, 5.5%. So if you look at the distance the Fed has to cover, tighten the economy versus what the RBI is doing, there is there's some sort of a detachment of central banking policy happening between India and Fed. And even in an interview, the finance minister said that is the case because they really have been working on detaching from the global central banking policy that is happening in other countries because of their particular economic situation. So what that just means is that the way it's INR USD is going to interact, and hence impact our current account deficit, oil imports, gold imports. That will have a feed-through effect into the economy of India. But apart from these two, main mechanics, the rest of the Indian is a very domestic, investor market, especially in the small and mid-cap segment. So that will, I think, there we are seeing a lot of latent value.
So since we're talking about fintech, Abhishek, I just want to come back to that as we're ending tonight's interview and ask you and understand from you what the future really of fintech perhaps is looking like. What can you tell us, shed some light on that for us?
The future obviously is more digital, that is for sure. But the relationships could be more physical, the brands could be more physical. So what I mean by that is a lot of the mechanics of how wealth management or fintech gets done might be digital, but people are still looking for that personal touch.
Sure.
So as we progress, what we'll see is that more and more technology getting applied to weak market hypothesis, where you are looking at prices and volumes and very basic couple of data points to identify something very quickly using a deep learning model. That's quite possible, I think.
All right, Abhishek, pleasure as always chatting with you. Thank you so much for your time.
Thanks a lot for your time.
Out of time on tonight's conversations, we do these series of interviews with India's foremost finance minds, helping you understand how to manage your money better. If there's someone that you want to see on the show, or if you have any questions for the experts who are coming on our show, this is how you reach us. Our details on your screens as I speak. With that, we're closing tonight's show. Thank you for watching. Have a good night.